Good morning, everyone. This is T3 Live Editor-in-Chief John Darcy here with Marc Sperling, Director of Trading with T3 Trading Group and one of our main contributors to the T3 Live virtual trading floor. Pleasure to have you on this morning, Marc. Something a little different we've never really done before.
We have not done this together. I actually took a hiatus from on-air activity for a little while. I don't know. Yeah, I'm a little nervous, not really.
I think it'll be a nice back and forth. We have a little different perspectives
course
on the market and hopefully give you some valuable information here for the end of the year. But anyways, futures are up very slightly this morning. After yesterday, we reclaimed most of the losses from earlier in the week. And we talked earlier in the week about how it's pretty rare in 2013 to see a 3-day correction, but losses were very muted. We didn't meaningfully close below the 8-day moving average. What's your take on the market this week and then heading into the rest of the year?
I think, at the beginning of the week, you could have, after, I guess it was Monday's action or Tuesday's reversal, Monday or Tuesday, I forget the day, you could get a little scared. But you know what? We've had this now 4 or 5 times a year, 4 or 5 times this year. Maybe there's a week, maybe there's a 2-week, a little bit of a sell-off, a little bit of scary action, and they always seem to recover. The rotation continues to happen. I think the playbook's staying the same for the entire year. I don't think it's going to deviate. 1,600. 16,000, where we're at new highs. We could hover, we could shuffle, but I can continue to see rotation, which is key. The banks are now finally, waking up, and that's the rotation we're looking for.
Yeah, like we talked about earlier in the week that, if you're a trader and you're actively looking at a lot of momentum names, we saw the 3D printers obviously get whacked really hard, and you saw some other momentum names really get hit earlier in the week, but the indices actually held up relatively well. And like you said, one of the reasons for that was the banks. What do you think the banks, strengthening means for the rally for the broader market through the end of the year?
I think it just means that the rally's on and the chase might be on. When the banks don't, the rallies don't last too long unless the banks participate to some extent. And now that you have, J.P. Morgan, Wells Fargo, Goldman Sachs, Citigroup starting to really break out of bases, or some of them are at, yearly highs.
Let's start to look at some of these charts. We'll first take a look at the chart of the SPY. As you can see, we talked about how yesterday, it wasn't a huge rally yesterday, but then again, the losses earlier in the week weren't that significant either. And like we said, there was no meaningful close below the 8-day moving average. We held the prior breakout level. What are you seeing here on the chart?
I see a nice little bull flag forming, as I've seen almost just entirely the entire year. Little digestion. I'd like to actually see another, few days of digestion for us to actually break through that level. That's really what's been happening all year.
And we take a look at the XLF, as we've talked about, a lot of leadership here, which hasn't really been the case the latter part of 2013.
Correct. And now that you have the banks rotating into new highs, most likely,
You zoom out on the monthly chart, you actually see, there's room. Obviously, financial crisis definitely changed the paradigm within the financial sector, but as we'll see with several of the charts in the group.
There's a lot of room. There's a lot of room, and we're going to be in a low interest rate environment for a long period of time, according to what Yellen was talking about. So, not that necessarily is the best for banks, but either way, you're seeing the strength. And
you look at Bank of America; it's been sort of the best in breed bank. What's your approach with these banks? Do you look to identify one that's strong like this and play this, or do you look for at this stage a more calculated type setup? Maybe one like Citigroup that we've been talking about and off the charts.
I actually got shaken out a little bit this week in some of my bank plays. Goldman Sachs, I've been in for a while. I actually took a bunch of my options off. So Bank of America, I just missed. They're boring. They're a little bit boring on the long side if you're trying to really jockey for position, from an intraday point of view. They obviously are a net long position that, if you're just swinging it's easier. You just got to know where you want to play. And after this week, I got a little bit, shaky with the market, so I just sort of, cleaned up some positions, got a little tighter.
Is it the type of situation where, as a trader who obviously, you're looking for volatility and stuff like that, you have 3D printers moving 30% in a day, and you have these laggard stocks moving 10, 15% a day, and you see a bank breakout, you see maybe a 2-3% move over the course of a few days, but is it not exactly the sexy place to look right now with all the movement we're having in momentum?
I think you got to figure out what your strength is, and as a trader, you can either spread yourself out when basically it's just pressing on the gas, or quite frankly, after the beginning of the week, put on a little brakes and say there's a little uncertainty. So I'd rather be where the high diesel, high beta stocks are, understanding what happened with the 3D printers. It's still one of the best in breed growth industry, understanding it got a little ahead of itself. But if you look at the SSYS and the DDD, even this morning, they have come back.
Those charts.
They have come back pretty nicely, and I know DDD just got some news about Motorola.
I mean, you look at the sell-off the last few days, and you look at the percentage. Obviously, a huge percentage sell-off. But then you look in the context of the move that it's had this year. It's really spitting in a barrel.
It came right down to support, basically. You know, it basically negated all of November DDD, and it came right back to support yesterday. VJet is another story. You know, SSY is very similar. VJet's another story. Even though I do think VJet is, just as it was overbought, it's now oversold. So it's a matter of understanding they always push a little bit further in the other direction. I think this one is probably a candidate to, once it gets some momentum going in its direction, which we thought was going to be yesterday, a move above 39, 39.50, you'll get a move to probably 43 quicker. And
the other theme that started to come back on our radar in the last few days is strength in the biotech sector. It's a group that was strong for portions of this year, but it weakened a little bit. But then BIIB is up big this morning, and the sector ETF, the IBB. We'll first take a look at BIIB.
BIIB's up a lot this morning, but you also got a little look last week or it might have been the beginning of this week with PCYC had some news.
You can see BIIB up at 275.
Yep. So. And PCYC last week had some news, and it basically woke a lot of the biotechs up. Then you had REGN had some news, and again, the rotation continues to happen. Bios have been a little bit slow for a little while digesting. That's healthy. But you can even see with the IBB, the ETF.
Look on the daily chart. This is one of the more calculated setups that I see right now in the market.
The key to trading, though, trading 101, you got to make sure you take a. If you're gonna be in one of these moves, you got to understand how the stock actually trades, the characteristics of the stock. They can tend to be tough stocks to actually maneuver, even from an intraday or even swing perspective. So you just have to have the conviction and really fight for your prices.
Definitely in the biotechs, there's a lot of gap risk. To both sides, you can obviously get big gains if your stock gaps up. You can get big losses if it gaps down. Does that make you more inclined to trade something like a biotech ETF where you don't have the stock-specific risk that you have in an individual name?
I think it certainly takes some of the headline risk away from you. And if you want to be exposed to the biotechs, the IBB is certainly one of the best places to be from that perspective. You're not going to get as much bang for the buck as playing the BIBs or playing PCYC from a daily perspective. But again, it's about risk versus reward and trying to capitalize on what you think is actually coming into the market.
And then one area that has really not gotten a lot of attention this week is sort of the large cap, high beta names, not the extreme momentum names, but the very popular names, the Netflixes, the Facebooks, the Apples of the world. Give me a few names in that group. We talked before the show that you think those are going to start to improve and perk up a little bit.
I think it's the healthiest action we can get. You've had diesel moves, certainly, and Netflix pulled back, but then it really has recovered very nicely and above 350. Looks like it's back to game on the long side, and shorts are going to continue to get squeezed. Apple really all year has been a little bit lackluster. It might remain this way all year. No need to show it. The book's already done, but no need to really press it. But it's something that obviously needs to be watched. But then you have the Googles, you have the LinkedIns, you have the Facebooks. I think are digesting nicely right here. Google really made a high earlier last week.
Google definitely looks like the most constructive one to me. The other one's a little bit.
Also got a $1,500 target on Goldman. Maybe that's the top tick, but either way, Google is still. But Google's best in breed. Priceline, unreal. The action of that. It's not for everybody, certainly. But then you actually see some second-tier stocks that you wouldn't. They're good industries, growth industries, and they're pretty amazing. The moves. You have the Gogo, which is a new IPO. You have the Home Away, which is like an Airbnb, very similar, which to me looks very good. Gogo looks very good. I was talking about it at 20, on the chat. I was talking about it around 24, 25 is probably the key area, and you can see the key moving average. I didn't hold it, but again, because I'm in trade mode, I'm okay with that.
It seems like anything with social or new media, internet related, is just across the board right now is getting a ton of attention. You have a $3 billion offer for Snapchat in the private market. You have the Twitter IPO obviously going off.
And then a $4 billion from Google.
Yeah, $4 billion
turning that down with no revenues, with nothing. Maybe they're obviously smarter than me if they've gotten to that point anyway. But that's it's interesting to turn that to turn that down. I don't know. Yeah.
I have to agree with you.
I don't know.
Anyways, we'll wrap it up and just Mark, give us a little bit more color on your take today, next week, through the end of the year. And then maybe, I know you focus more on the here and now and the intermediate term trading, but into next year, you have Janet Yellen, the new Fed chairman, talking about low rates, maybe even more dovish than Ben Bernanke was. how does all that factor into your mindset and what you're going to be looking for through the next 12 months or so?
The playbook has stayed the same all year for me, just about. Every pullback, I look to buy the best in breed. I might not be perfect with my entries always, but I'm trying to be patient. I very rarely, and you can see it, are net short across the board in my positions. That has worked very well for me this year. I don't think that's changing. For the 2014, I don't think we're changing. I really don't. Everybody's like, we've gone too far. We certainly need digestion. You certainly would love to have everybody would love to have a 3 to 5 or 7% pullback in that. That's just going to create nice buying opportunities, nice longer bases for stuff to really catapult from. We have not gone anywhere in 12 years. Understanding we are now in a 5th year of this bull market from 2009. I get it. But the reality is we haven't gone anywhere in 10, 12 years, which historically means if you look at your weekly charts and monthly charts on any stock, when you break out of some sort of pattern after a multi-year base, usually you head higher with some real movement. I think we're in that mode. Retail, you could just tell, retail slowly getting back in, and obviously the last few months have slowly gotten back in. I think that will continue. I think they're a little bit smarter, but they're always going to be the guys who are going to top tick, unfortunately, this tape.
Yeah. My feeling is as long as people are hating this market, as long as you're seeing the articles posted about potential crashes and people wanting to be short this market, that'll be the fuel to help it keep going.
It makes it much healthier. It makes it much healthier. If as VJet, as some of these 3Ds, you see, they run too fast. They have they have a quick and violent way to fall. If they just digest and grind up, it's a much healthier way of going up, and that's really what's happening right now. We're getting, you get the banks moving this past week. You get high beta slowing down. You got biotechs, which are taking a break. They moved a little bit this week. You got some, defensive stocks moved 2 weeks ago, and now they're just taking a break. That's healthy. That's lots of rotation. Money's rotating from one sector to the next sector, and given these times to basically from a technical approach, build nice bases for us to go higher.
All right. Well, Mark, thank you for joining us this morning. Hopefully we can do this again, and good luck everybody trading today and through the rest of the year. And we'll get Mark back on camera here as soon as possible.
Bye, guys. I'm Marc Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF.